What if I told you that paying off your mortgage early could actually cost you hundreds of thousands of dollars? Most people believe the smartest financial move is to eliminate their mortgage as fast as possible. But depending on one number, investing the same money could leave you with over 280,000 more. In this video, I will show you how mortgages are structured to maximize interest, when investing actually beats paying off your house, and the one situation where paying off your mortgage early is the better move. But before we can decide whether paying off your mortgage early is smart, we need to understand how mortgage actually works. Every mortgage payment has two parts: principal and interest. The principal is the amount of money you borrowed to buy the house, and the interest is the fee the bank charges you for lending that money. But mortgages follow something called an amortization schedule, which determines how each payment is split over time. And here's the part that shocks most homeowners. In the early years of the mortgage, most of your payment doesn't go toward the house at all. It goes to the bank as interest. For example, on a 400,000 mortgage at 7%, your first monthly payment might be around 2,600. Out of that payment, about 2,300 goes to interest, while only $300 actually reduces the loan balance. This means that in the beginning, you are barely making progress on paying off the home. Most of your money is simply covering the cost of borrowing. Now, let's look at the real cost of mortgage, because the total numbers can be surprising. Imagine you borrow 400k for a house with a 30-year mortgage at 7% interest. Over the life of the loan, you won't just repay the 400k you borrowed because of interest. You will end up paying roughly 550k in interest alone. That means the total amount you pay for the house becomes about 950k. In other words, the bank earns more than half the original loan amount just from interest payments over time. This is why many people believe paying off a mortgage early is always the smartest financial move. If you reduce the loan faster, you reduce the interest you pay, which can save you tens or even hundreds of thousands of dollars. But here is the real question. If paying off your mortgage early saves so much interest, shouldn't everyone do it? Not necessarily, because there is another place that money could go, and it might grow much faster. Now, let's look at the alternative: investing instead of paying off your mortgage early. Historically, the S&P 500, which represents the 500 largest companies in the US, has returned about 10% per year on average since 1957. After accounting for taxes and other costs, a realistic long-term return might be around 7-8% per year. So, imagine your mortgage rate is 3%, which many people locked in during the low rate years. If you make extra payments toward your mortgage, you're effectively earning 3% return on that money by saving interest. But if you invested the same money and earn 8% annually, your wealth could grow much faster over time thanks to compounding. In many cases, this means investing instead of paying off the mortgage early can leave you with significantly more money in the long run. But this decision completely changes when one number increases, and that number can flip the entire strategy. Now, let's talk about the one number that changes everything: your mortgage interest rate. This single number often determines whether it makes more sense to invest your extra money or pay off your mortgage early. If your mortgage rate is low, around 2% to 4%, investing usually makes more financial sense. That's because the stock market has historically returned around 7-8% per year after taxes, which is significantly higher than the interest you're paying on your mortgage. In this case, your money has the potential to grow faster in investments than the interest you have saved paying down the loan. But when mortgage rates climb to 6 or 7%, the decision becomes much closer. Paying off your mortgage early in this scenario is like earning a risk-free, guaranteed return equal to your mortgage rate, because every extra dollar reduces future interest. For many people, that guaranteed return and the peace of mind of owning their home outright can be incredibly valuable. Another factor that plays a huge role in this decision is time. The longer your time horizon, the more powerful compounding becomes. Compounding means that your investment returns start generating their own returns over time, which can cause your money to grow exponentially. For example, imagine you invest $500 per month for 25 years and earn an average return of 8% per year. By the end of those 25 years, the investment could grow to around 470,000. That growth happens because every year your returns continue to build on top of the previous gains. Now compare that to using the same $500 per month to pay down your mortgage faster. In that scenario, you might save around 180,000 in interest over the life of the loan. While that's still a significant amount, it's much smaller than the potential growth from long-term investing. But if you decide to pay off your mortgage early, there are a few strategies that can save you years of payments. The first strategy is the bi-weekly payments. Instead of making one monthly payment, you split it in half and pay every 2 weeks. Because there are 52 weeks in a year, this results in 26 half payments, which equals 30 full payments per year instead of 12. That extra payment each year goes directly toward reducing your loan balance. The second strategy is adding a small extra payment each month, such as $200 toward the principal. Even a relatively small amount like this can shorten the life of your loan by several years. The first strategy is making lump sum payments. Whenever you receive extra money like a tax refund, bonus, or unexpected cash. Using strategies like this could save you over 130 in interest. So let's quickly recap the key ideas from this video. First, if you have a low mortgage interest rate, usually around 2% to 4%, investing your extra money often makes more financial sense. That's because the stock market has historically delivered high long-term returns, meaning your money has a greater chance to grow through compounding rather than simply saving a small amount of interest. Second, when mortgage rates are higher, around 6 to 7%, the decision becomes much closer. Paying off your mortgage early, in that case, is like earning a guaranteed risk-free return equal to your mortgage rate, which can be very attractive compared to uncertainty of investing. And third, your time horizon matters a lot. The longer you have to invest, the more powerful compounding becomes, which often gives investing the advantage over the long run. Ultimately, the best decision depends on your interest rate, timeline, and personal financial goals. But there is one huge mistake people make when deciding how much house they can actually afford, and it keeps many homeowners financially stuck for decades. If you want to avoid that mistake and understand how to buy a house without destroying your finances, watch this video right here, where I break down the exact numbers you should follow.